Okay, I think we'll get going. There's a little bit of news this week, not too much, but the guest is James Harris of Securities Trust of Scotland, who was on the show almost a year ago, April last year. So he's going to be updating us on what's been happening with that fund since then. So news this week, the big one for us is probably Jupiter Emerging and Frontier Income, which seems to have decided to go up the ghost, and ScotGems, which probably should but isn't. And then I thought I'd mention Allianz Technology because water prices' replacement has been announced. Starting off with Jeffy, it started off very well. As you can see here, it traded at a premium for quite a long time. Performance was okay. And then it got hit quite badly in the sort of pandemic panic of March 2020 and didn't really recover. And obviously it's been hurt more recently by what's been going on in Russia. Here it stands in the sector. It's obviously it's not very big. I think this is fundamentally the problem. But the discount is relatively tight now. And one of the attractions that it's always had is it's offered the highest yield in the sector. And we thought maybe that was enough to secure its future. But because it's small, its ongoing charges ratio is relatively high, and that may be counted against it. In terms of performance, and I think this is the key thing, is it's really not too bad. There have been periods when it hasn't been working so well, but actually over the piece, it's been okay. And that's why I think it's disappointing that we've got to where we are. ScotGems that we're talking about later on, as you can see over 3 years there, is by far the worst performing of all of these things. So Jeffy is not quite 5 years old, so it's launched in May 2017. And one of the things that we sort of celebrated at the time was that for an equity launch, it was actually a reasonable size. And the hope was it was going to be able to expand from there, especially because it was trading fairly close to asset value. When COVID happened, China outperformed quite significantly, and because it's such a big weight in the emerging markets index, that meant that any EM fund that was underweight China was really struggling, and that was a problem for it. And I think that is one of the things that helped increase the discount. Things have improved since China underperformed in 2021 with the sort of crackdown on various big tech stocks, for example, but not enough to capture the imagination of shareholders. In terms of Russia, it was big but not enormous. So 7.3% in Russia at the end of 2022, January 2022. And Ross is quite happy to say that he just didn't think that Putin was going to invade. And I think it's wrong to criticize people for not guessing that. By all means, you can criticize people that were overweight massively to Russia because given the risk involved. But I don't think people thought that it was the logical thing for Putin to do. What he did manage to do is sell at Sberbank before the trading was halted, and that's not bad going, really. So what we've got left with is Russian exposure of 0.4% on the 1st of March, and obviously that'll be valued at nil today, the same as everything else is Russian exposure is. Now, the reason it shrank, one of the things that it offered at launch was an annual redemption facility. And the initial shrinkage through that wasn't too bad, but in June, because of the underperformance in 2020, I think, because the discount was relatively wide, they had 30% of the shares in issue tendered. The board was not sure what to do about that because they obviously wanted to expand, but it wasn't trading at a close enough discount. And so they canvassed shareholders and then suggested on the 10th of January that there'll be a continuation vote now, and then there wouldn't be another redemption opportunity for 3 years. And when that happened, only 20% would be able to be redeemed. So they published a circular to that effect on the 11th of February. And then on the 24th of February, they said, shareholders have been back in touch, and they're not so keen now, and so we've decided to abandon this approach. And then on the 8th of March, we were really quite surprised to see it decide to opt for liquidation. So the board served notice on the manager, and the whole thing is now sort of heading rapidly towards the exit. I do think this is a shame. I do think the manager's done a reasonable job given very difficult markets. We were hoping that 2022 would be a better year for emerging markets generally, especially emerging markets outside China. Obviously, what Russia's done has kiboshed that to a large extent, although there's a possibility, I suppose, that other markets will do better. Things like Brazil, maybe, so other places that produce commodities outside of Russia are going to be beneficiaries of the rising prices. One thing that I would say, thinking about this, because there are lots of different ways of trying to tackle discounts. There's lots of different ways of trying to handle the reasonable requests for people to get out of funds when they want to. I don't think that offering an annual redemption facility, especially an uncapped one, is a sensible decision for any fund, to be honest. And it's not something that, if people come and ask me, that I'd be encouraging people to do in the future. It just encourages short-termism, really. A year isn't long enough to make your mind up about a fund. To be honest, I'm not quite sure that sub 5 years is long enough to make your mind up about a fund either. But we are where we are. And given what's going on, they may offer a rollover into an open-ended fund. Obviously, I'd much rather you just took the cash and then reinvested it in another trust trading on discount. And then when global emerging markets do eventually outperform again, capture that discount narrowing. So it makes much more sense to me to do that. That's Jiffy. ScotGems really has not been good. And you can see here the way that the discount moved from fairly soon after launch. It's never really won much favour with investors, and for good reason. It launched in June 2017, so a month after Jiffy. It's slightly weird that the way that its remit is worded, it reads like a normal global small cap trust, but it's always had an emerging markets focus. And I don't know why that's not in the investment objective, but it hasn't been in there. It's always been smaller than Jiffy is now, and Jiffy's saying we're too small to carry on. And the discount now has gone out to 19% this fund, and it's never bought any shares back because the managers are really concerned that it's too small. The track record, as I said, is pretty awful, and if you go back to those numbers we were looking at earlier on, so it's underperformed Jiffy by 10% a year over the past 3 years in NAV terms, and obviously the discount's wide too, so that's been worse for shareholders. This is what they put in the annual report, which was published today. So basically saying it took us too long to get the money invested and the market was going up. There was underweight China, which on corporate governance grounds, which is maybe okay. They didn't invest in places like South Africa and Taiwan because they thought they were too expensive, but they did pile into Africa and then lost a lot of money. So really not great all round. And a few redeeming features, I think that's the trouble. And then Matt spotted this morning, but I think it's actually quite sort of comical in a way. So this thing has never really invested in Russia because it's got this sort of strong ESG mantra, although it does invest in all sorts of oil and mining and all sorts of things. But then on the 24th of February, it put 1.1% into Russian stock called Fixed Price, which obviously now is valued at 0. That just is just weird. I'm not sure what drove that. There's some other exposure through a Turkish bureau. That's not really not material. And obviously against Jeffy and Templeton and JP Morgan Global Markets Income and the other funds that have had a bit more in that, that's not the end of the world. But it does sort of put a question mark in my mind about what they're up to. Now, the whole thing with the manager is quite complicated, but basically it's a whole load of different names. So eventually the unit is called St Andrews Partners, and Tom Prue and Chris Gray work for that bit of the firm, but it's all part of First Sentier. And then on 1st of March, Versentia said, we're going to close down this team. And then it resigned as manager of ScotGems on the 9th of March and gave their board 6 months to find a new AFM. So they'll resign earlier if somebody comes along, so they're not sort of being greedy about the fees. The board says it's already had a lot of expressions of interest, which is interesting. I'm not sure who'd want to get hold of a 35 million market cap fund with a poor track record, unless they wanted to take it over and shake things up a bit. But you have to convince the board and the manager that this was a good idea, because they own a quarter of the fund between them, and the board are quite eclectic. So we'll wait and see what happens. But yeah, I don't know. Excuse me a second. That's better. Right. Allianz Technology. I've put the long run track up here because obviously Walter Price has been running this fund since it was launched, and he's now going to step down. And really, it's done a great job. Although, as we can see here at the moment, it's trading on one of the widest discounts that's been on for a very long time. So, a chap called Mike Seidenberg, who's been part of the team for more than 10 years, is going to be taking over in July. And he's got a reasonable track record. But Walter has been working in the sector for a very long time. I mean, joined Allianz in 1974. And the performance is great. I tried to find the performance since launch, and Morningstar tried to tell me it was 197%, so it's clearly wrong. But so I just took the numbers from the end of 1999, and you can see there it's massively outperformed the benchmark, which is the Dow Jones World Technology Index. More recently, because this has kind of been sparked by the publishing their annual report as well, it's underperformed over 2021. And that's just giving back some of the really good performance it achieved in 2020. And it's notable, I think, that even though sentiment has turned against technology and growth, and Allianz is bound to be sort of affected, the pullback is nowhere near as bad as is for something like Scottish Mortgage. And that's because it's invested in more in companies that have got profits and revenues, and less in things that are more speculative. But because of the pullback, because of the general antipathy towards this sort of area of the market at the moment, it's not an 11% discount. I think that's probably cheap. The market's sort of gone defensive, so it's gone into the mega cap stuff and more cyclical things. I think it's notable that it hasn't got anything in China. I'd say at this sort of level, it's looking more interesting, really. And you could say exactly the same thing about Polycap Technology. There's reason a lot to distinguish between them in terms of the discount, in terms of the recent performance. It's all very similar. So either one of those, I think, might be interesting. We'll have to wait and see whether people switch from one to the other because of the new manager. But obviously, as I say, that he's been there for quite a while. So that's enough from me. And we're now